sector investments come. And this is all underway. The termination payments, the kind of changes that we have in the concession systems we have put in place, these are all, risk mitigant measures. And perhaps we have to talk something about the termination payment system, because having the largest PPP exercise in the world and having the road sector, occupy a dominant position in that, and a few other sectors which also offer termination payments. These are all again coming from the government's, budgetary resources. So this is again a big credit enhancement for the system that nowhere in the world, such a kind of push is there. Going forward, version 3, yes, I was coming to that we need to have financial sector reforms. Particularly looking at non-banking finance companies, IFCs, infrastructure finance companies, with the same yardstick that is being applied to the non-banking finance companies in the retail sector is not really conducive enough. I think the regulator will have to take note of that and see that infrastructure-specific regulations can be applied into our economy as well, because there's a latest World Bank study which says 110 countries surveyed by the World Bank. I think this was out only in May 2024. Out of the 110 countries surveyed, 76% of the countries had infrastructure-specific regulations, and 56% of the countries surveyed had infrastructure-specific laws. So I think it's time for India to get these things in place, because predictability of cash flows, enforcement of the terms of contract, these will need to be served across the stakeholders' interest. I think these all have to, be put together. I think that will help, in getting more investor interest into this sector and the economy as well.
See, broadly, what you look at is that why do you require capital formation? Because it will create jobs and it will create growth, right? The framework, the way I look at it is slightly different, because the way we look at the economy is from the lenses of the rear view mirror. That it happened in the past, that's why it will happen in the future. Past is a good guide to the future, is a general purpose activities on all our mind. We think it happened in America, it happened in Europe, and stuff like that. But today there is a break. See, there are two significant sectors which have not been understood on the second part. The first part is what I call hard infrastructure, which is the ports, roads, airports, and every type of infrastructure, which including sewage lines. And so it helps you, at least there is a perception that will help you create more growth, more jobs, and other things. India is lacking in that. Hard infrastructure, India has been perennially lacking. And why? Is because we were capital deficit from independence and even pre-independence days, right? So we were not having that capital. We could not have invested. Now we are trying to make the hard infrastructure, all the ports and roads and whatever, at a breakneck speed, and hopefully in next 20, 30 years we'll make that. The manufacturing part, which we think is going to create jobs. And it's not that today we are thinking. We have been, in fact, Baba Saheb Ambedkar wrote about it in 1920, about shifting the agricultural labor to the industrial labor, because that time there were no services. Why I'm telling you this, we have been investing tremendous amount of money in industry, and we'll continue to invest because there is still a lot of juice left. But walking in the footsteps of somebody will be me too. We need to have our own strategy. We have created those strategies, the PLIs, and also we have now got some great short-term achievements in terms of manufacturing iPhones and exporting them. And so for me, the manufacturing is the second part which guzzles capital. Third part is agriculture. How much capital we can put in, how many people we can replace from the labor into the agriculture, into other areas. And the last part is services, which also in some ways dovetails into the soft infrastructure. Today, our hard infrastructure is pretty much not that great, but our soft infrastructure is the best in the world in terms of the public private everything. Today, $2 a month gets you 1 GB or 2 GB per day downloads. Most of us use it for watching movies, but also we do transactions and other things, right? And so for me, the next future growth of the jobs and also what you said, 6.5, 7, for me, it can go to 8, 9, 10 because the technology is going to create that wealth much faster because technology waves are coming faster, the wealth gets created by technology, and that's where the soft infrastructure, the country which has it, is going to create more digitalized assets, whether experiences, AI, and what have you. And for me, that is where India is best place, where you put in little meat and you get a lot of output. And that is why I call it non-linear outputs or non-linearity of payoffs vis-a-vis the physical infrastructure, physical manufacturing. They are in a way linear. You put in a lot of money and hopefully you will get a lot of money out. Whereas here, you put in little money, you get lots of money out. And we have so many examples of that happening in India. Say Infosys, very little money put in. Now, so many people are billionaires and many more millionaires and others. And that is true with Zomato and Swiggy and whatever you have. And that's why if you separately think of them, that services we are doing well, should we think that it doesn't require any investment at all? Or it doesn't require any nurturing or sort of exports and stuff like that? That's where for me, if we take all of that combined, we need to do investments in the infrastructure, in the manufacturing and other things. But also, let's not forget services. And also, on top of that, the dematerialized services, the newer gaming and everything else that is going to come, which is going to create more wealth in the future, we need to also focus on that.
Yeah, I just want to build on a point, striking point Anant made during his remarks. And I think in that lies probably the biggest opportunity for India. You know, he said that they have cut, for example, in one process alone, 45% of the data that people had to provide to achieve the same process requirement that earlier on, SEBI required. I think in India, our biggest need is ease of doing business. If every department, state, or center, every regulator can basically cut its process requirements by 50%, and we can chop regulations by half, you will unleash such animal spirits in this country that all the people who are nascent entrepreneurs and all the people who basically are spending half the day running from pillar to post, filling forms, they will suddenly start becoming productive.
If I can just add to all the comments so far. First off, on savings, Rajiv, both you and Amit mentioned about savings being on the softer side. Incidentally, we are in touch with RBI and MOSPI. We actually have ground level, bottom up savings data in our securities market ecosystem, which doesn't require estimation, which is the norm in the other countries. So you will see some, hopefully, changes coming out in the savings number. But I think the larger point is it's very clear within the savings mix, the saver moving to investor, the capital market part of the savings is definitely on an upswing over the last few years. So I think the savers moving to investors are doing their bit for capital formation. So much so that frankly, as a regulator, our focus is on ensuring there is risk awareness, ensuring that people are not coming in with their eyes closed, and ensuring that a lot of money and time is spent on things like cybersecurity, information security, risk awareness, education, and so on and so forth. I think the time is now for the issuers. If the risk, if the investor is available now with the risk capital, we need issuers to step in and raise these funds now. We are seeing a bit of that. As I said, we are seeing record level of equity raising this year. It's a complete record not seen in the past. Already 3.1 lakh crores. But beyond, and I want to echo what Mr. Jaishankar said, things like InvITs, REITs, munis, essentially monetizing existing operational capital so that you free capital for generating fresh capital. One estimate that we did within SEBI is that the total potential market size of things like InvITs, REITs, monetization of existing capital can be, the market cap of that can be as high as our GDP. We are a fraction of that currently. So I think doing the education, building the trust, making sure things like valuation, things like whatever it is that is required to build in the trust, and of course the larger education, so that these instruments for actually raising capital and then converting them into productive use, I think the ball is frankly in the issuer court, many of whom are here in the CII community. The last bit I want to add to what Amit said. I don't disagree that making sure that regulations are facilitative. As I said, the type 2 errors, reducing the type 2 errors. I completely agree with that notion. I'll tell you what our challenge is sitting in SEBI. We are, as I said, mortified by the prospects of both type 1 and type 2 errors. We get very nervous when we see lobbying entirely on type 2 errors or reducing them, turning a blind eye to what we see as very, very consequential, obvious cases of type 1 errors. My request to CII is the following. One, it's a very noisy world, particularly in this world of social media, where the amount of advice we get every day is just immeasurable. We have to sift through it. So you as CII, you could do us a great service and do yourself a great service by getting some degree of consensus and presenting what you think is a policy prescription to reduce the red tape and so on and so forth. Second, along that, please be a trusted advisor. Before we find out through our inspections or through some friends in the media or through some other intelligence that something egregiously wrong is happening, tell us it's happening. This is not snitching. This is purely saving the ecosystem. It's not a question of morality as well. I'm simply saying anything that goes wrong actually threatens the trust in the ecosystem, and the saver who's becoming an investor can be put off by that. It's a matter of preserving that ecosystem and not killing that golden goose. Please tell us if you see something, say something. So both of this, be trusted advisors, if you see something, say something, and advise us once you've gained the trust as a trusted advisor. Tell us what changes you would want. I'm sure we would be much more open in our hearing then.
Thank you very much. Excellent points. I know we have completely run out of time, but if for 2 minutes anyone wants to comment on bond markets. I know we have a very sophisticated equity market, but the bond market is relatively still not developed.
I wanted to say something about bond market. I'm glad, Rajiv, that you've asked that question. When we are talking about savers becoming investors, and much of this investments is not only happening in the equity markets, it's going to the mutual funds, it's going to the pension funds, it's going to the insurance funds. So I think we've been debating on the depth of corporate bond market for so many years, and we could never achieve that depth. I was just looking at SBI is the largest issuer of the corporate bond in the current market. And I'm sure that there are a lot of corporates who would like to issue the bonds. We have issued about 50,000 crores worth bonds this year. But I definitely believe that if the savings, household savings or corporate savings, are finding ways into these three investment categories, it is important that the pension funds, insurance funds, and the mutual funds also actively participate in the corporate bond market. I don't see that kind of participation actively coming in. Even if it is coming in, it is coming near sovereign risk, or AAA bonds. And that is not really going to help in terms of deepening the corporate bond market. And eventually, even when you talk about the infrastructure financing, there's only so much the commercial banks can do because of the ALM mismatches or the ability to fund long gestation projects. So somewhere the corporate bond market has to come into the financing of infra as well as the balance sheet funding of the corporates. I think that's very much required. One piece of important enabler what RBI has given is for the banks particularly to put the corporate bonds into HTM category, held to maturity. But we still have been negotiating with RBI that even if I put in the HTM, I still have priority sector obligations on that, which means that it's going to really put pressure on us. And I'm sure, I think all of us have to really think how do we deepen the corporate bond market.
Thank you very much, sir. I think we need to now close. Can I have a round of applause for an excellent, outstanding panel? Thank you very much.
Thank you, Mr. Memani. May I request you to kindly hand over a token of appreciation to each of our panelists, please? And then we'll have a photo op and close with that. Post-lunch, the applauses should be... Thank you so much.